Welcome back here with Money, and we are discussing the fine print of Budget 2016-17 with Mr. Harsh Roongta. So, Mr. Roongta, we've discussed gold, we've discussed housing and real estate. Now let's talk about some of the clauses that might have some meaning for the HNI fraternity. And I'll start by asking your outlook on the VDS scheme of sorts that we've got this time around. Come, disclose your income, pay 45% tax, no questions asked. Do you think there'll be any takers?
A 45% tax rate isn't exactly small. I mean, and it is 45% of current value. So you would have got some income that you have not disclosed to tax. That income would not be lying in a bank account. It would have been invested in a certain asset, right? And that asset value as on 1st June 2016 on that. So even the appreciation of that
will be taxed.
You would be taxed, and you would be paying 45% of that. And obviously, I think the fine print on whether it will give immunity from other laws, etc., all that needs to be seen. But clearly, I don't know how popular it will be, but it is quite a significant move.
Also, the tax rates seem to be slightly higher than the last time the government came out with a disclosure scheme like this. I believe last time the rate in which the tax was applicable was different. It was a 30-30 break between the maximum slab, IT slab, and then the additional surcharge. How do you rate the rate of tax itself at 45%?
As I said, the maximum marginal rate today is 30,
right?
Because the surcharges are going to apply to 45 as well,
right?
So if against 30 it is 45, more importantly it is 45% of the appreciated value. So you might have had undisclosed income 10 years ago, and on that, if you bought an asset and that has appreciated, suppose you bought a gold bar and that has appreciated, then typically you would expect to pay a capital gains tax on the gold bar,
right,
which would be at a much lower rate given indexation and all that,
right.
But here you would have to pay 45% of the value of that gold bar as on that particular date. So it's not a small sum of money. I think it is a major announcement. I would wait to sort of think about what implications it will have. It is definitely something that will be of quite a lot of interest to people with undisclosed income.
A couple of the other fine points that came out of the budget speech, at least, the finance minister making it clear that capital gains will not be taxed if invested in a regulated or notified fund of funds by an individual in notified startups. This one avenue, and of course they also went on to clarify, the government, that the period of getting the benefit of long-term capital gains regime for unlisted companies has been reduced from 3 years to 2 years. Now, for a lot of the high net worth investors who might be investing in some of these unlisted securities or who might have the corpus of investing in the Startup India Fund, to what extent does it help them?
So, unfortunately, the 3 years to 2 years bit, although it's mentioned in the speech, it doesn't find its way into the bill.
Okay.
So, I think that's something that probably will get corrected. That's bound to get corrected, because if the finance minister has spoken about it, it's just probably been not put in by mistake. The other bit, the fund of funds, now this is a additional exemption for capital gains. Today, if I have long-term capital gains up to 50 lakhs from anything, I could get that long-term capital gains from any asset. I can put in 50 lakhs into the 54 EC capital gain bonds in REC and NHAI, and that would then be exempt. Over and above this 50 lakhs, now another provision has been introduced that I can put in another 50 lakhs in this fund of funds,
which is a Startup India
fund. Is a Startup India Fund, which in turn I think is going to invest in funds that invest in startups.
But this is only a deduction with respect to the capital gains tax liability that you're dealing with, not your overall income tax liability.
It's long-term capital gains. Unlike the bonds which are AAA rated, although interest rates is only 6%, but they are AAA rated, there is no risk. At the end of 3 years, you're free to take the money and do with it whatever you want. Here, I mean, for people to invest in a fund of funds that's going to invest in funds that are going to invest in startups.
And it's an equity fund,
It's an equity fund. Income is taxable. And liquidity is not assured. I mean, a startup fund giving back money in 3 years is very, very difficult. So liquidity is not assured, the eventual outcome is not assured. So I don't know how many takers there will be. A good thought, but really speaking, I don't know whether there is a match between people who make long-term capital gains and whether they would want to invest in a fund of fund like this.
All right, so final thoughts then as we're drawing our conversation to a close. How would you rate the budget on a personal finance scale? What were the biggest takeaways for you?
According to me, the EPF and NPS controversy, if it had been rolled back and portability had been introduced by making NPS equivalent to the EPF, I think that it's a missed opportunity. I would say that's a missed opportunity. It should have been done. Deferring it is essentially deferring it probably for a long time to come.
They've called for a comprehensive review. That's what the statement said. So we'll wait and see what the government comes up with. But thank you so much for taking out the time and being with us. And thank you to all our viewers as well for joining in on this week's episode of Money, Money, Money. Of course, you can reach out to us. Our email ID is on your screen. You can also tweet your thoughts, your questions or queries to us. Thanks for watching.